Good afternoon, everybody. Thanks for attending this session today, which is titled Global Forces Driving Markets. My name is Brent Hopping. I'm the Senior Employee Benefits Advisor here at Certe, and I'll just do the intros and do the Q&A at the end of the session. Just in terms of today, we'll do a question and answer session at the end of the presentation. I'll be monitoring that, and please put any questions in there. The chat is not being monitored, so please don't put your questions in the chat. Cameras and microphones are obviously turned off for the moment. We'll moderate the Q&A through a discussion at the end of the session. So the purpose of today's session is it's about a conversation to give you insights into or about the economy, markets and themes set to shape 2026, and there's a lot going on, especially over the last week or so. Before we kick off, general advice warning. This presentation is intended to provide general information only and has been prepared without taking into account any particular person's objective, financial situation or needs. So any general advice given during this presentation does not consider your individual objectives, financial situations or needs. Nothing in the presentation is intended to be investment advice or financial advice. So please, if you get, I hope we do get a lot of useful information today, please seek advice or reference any relevant product disclosure statements. You may have only logged into one of these sessions for the first time today, so I just want to give you an overview of who is Certe. So we're a financial wellbeing and individual client business. We develop, manage bespoke employee benefits programs and provide personalised financial planning advice. We have specialised knowledge to help protect and build your business and personal wealth through things like financial wellbeing for employees, group insurance, corporate superannuation and private partner advisory. We're also joined today with some partners from Quilla, and Certe partner with Quilla for tailored intelligent investment solutions using managed accounts. So portfolio construction, management and reporting. Specifically, our presenters are Alka Kalasabail, who's the Senior Advisor here at Certe, Aaron Lewis, Head of Equities at Quilla, and George Mavris, Senior Investment Analyst at Quilla. Before we kick off today, we're just going to start with a quick poll. And what we want to understand here for the audience that's attending is, do you know what your superannuation fund investments are in currently? So that poll will kick off just in a moment. And while you're answering that, I'll hand over to Alka.
Okay, thanks, Brent. Our aim today is just to provide you with some food for thought on what are the major forces driving markets during an increasingly volatile time. Our first theme for today is economic outlook. So that's essentially a bigger picture view of how the overall economy is structured and the key inputs that are shaping the months ahead. To kick us off, Aaron, can I ask how you would describe the overall economic backdrop at present?
Thanks, Alka. So our view is the economic backdrop is actually quite supportive for financial markets currently. Now, that may come as some surprise given all the volatility we've had in recent weeks, but when we look at the key building blocks of the economy, we actually think it's in a pretty reasonable spot. It is a little bit uneven when you look around the globe. Some economies are doing better than others, but the big ones of the US markets and the US economy and Australian economy are providing quite stable and resilient economic growth of 2 to 2.5%. If we look at Australia, growth has been stronger than expected, and now we're in a rate hiking cycle. So it's important to remember that. Another key building block here is unemployment is really quite low, in the 4 to 4.5% range in both Australia and the US. And that's very important for consumption, housing markets, etc. So even though there's moving parts around, AI disruption or artificial intelligence and what it means for the jobs market, the forward-looking indicators are still pretty positive there. Inflation is a little bit higher than particularly the Reserve Bank of Australia would prefer. But again, that's reflecting that stronger growth as we've seen some stimulus in the Australian market. And again, artificial intelligence, potentially some quite big productivity payoffs globally. And we know that's been a major issue in the Australian market and economy, the productivity. So yeah, generally when we look around the globe, things are pretty supportive.
Perfect. On a related note, what indicators are you watching more closely when assessing global growth?
Yeah, so we're in the information we look at day to day, we're not, there's no shortage of indicators we can look at, but we do try and be more forward-looking in the indicators we're looking at. So you can see here on the page, this is GDP growth around the world, and I'll point you to Australia where that GDP growth is increasing. So the first 4 bars are representing quarterly annual GDP growth, so the yearly rate, and the next 4 are for 2026, so they're more forecast. And that growth trajectory in Australia has been quite positive. Now, we do like survey-based indicators for businesses, and the key one we look at in the US is the Institute of Supply Management, and they ask a lot of businesses, you know, how confident are you? And the read there that we've had in the last few days is it's at the strongest levels in a number of years. A lot of industries are in expansion mode, so things are quite positive. And the read on hiring intentions is actually very strong. So that's quite different to what you might be reading in the headlines about job cuts and whatnot. Businesses are certainly seeing growth, they're seeing new orders coming in, and that's quite positive. Now, obviously, we watch the jobs market very closely. That's very important, but the forward-looking indicators we're seeing are broadly supportive right now. So.
If we shift gears slightly and talk about inflation, inflation picked up late last year. Do you think we're past the worst of it, or do you think there's more volatility ahead?
Yeah, we're certainly not expecting a return of the post-COVID inflation bump you can see on the screen here. That was a very extreme level, and we're certainly not expecting that to come back. But in terms of where we sit right now in the Australian context, we're a little bit uncomfortably high. So we've had January inflation data coming in the last few days, sitting up at 3.8%. That's the headline level, which includes more volatile components. This is the trend mean, which tries to assess the more underlying, you know, less volatile components. The RBA targets is 2 to 3% inflation band, and we're sitting at that 3.4. Now, they're trying to get back to 2.5, and that's actually quite difficult to shift inflation. And it's been much worse than expected. So August last year, they were thinking it would get back to 2.5 relatively quickly. Now they're not expecting it to happen until 2028. So it's going to be quite a long path to get back, which does support, you know, a few more rate hikes this year. So even though we're not going to go back to those very high peaks we had previously, we are going to have a few more rate hikes to try and get that inflation back a bit lower to a more sustainable level.
Perfect. If we can then bring interest rates into the picture, George, can you talk us through the impact of that?
Yeah, so Aaron touched on it just previously. It's probably why most people are on this call. How many interest rates are we going to get? How much am I going to be paying extra home loan repayments? And unfortunately, it's not great news. We've obviously started a rate hiking cycle in Australia. You may be able to see on the chart, there's a bit of a faint line showing the difference between the US and the Australian market and what markets are pricing in terms of either rate hikes or rate cuts. Unfortunately, obviously, Australia is drifting up and the US is continuing to drift down. At the moment, the markets are expecting 1 to 2 more rate hikes for Australia. The next rate hike has been priced in for May. And depending on the inflation data and the employment data that we get from, you know, the future months, we may see another rate hike in November at the moment. So yes, unfortunately, 1 to 2 rate hikes priced in at the moment. And the RBA will be data dependent to see whether or not they do hike it further in November.
Thanks, George. Brent, can I call on you just to share the results from poll 1?
Thanks, Alka. Yeah, in answer to the question, do you know where your superannuation's invested? 48% are saying yes, which is quite high. We've obviously got a very educated audience here this afternoon.
Thanks, Brent. I think that it's always good to know where your money is invested. You work hard for your money, so you want your money to work harder for you. That's a good foundation for us to perhaps wrap up the first theme of today. I think for me, the key takeaway was that the global economic growth is expected to remain positive, but there are a number of inputs that make us feel cautious about the months ahead. I think this is a good segue into our next theme for today, which is performance, the big topic. Within performance, we want to provide a more balanced view of what markets have been doing and also consider how different parts of the market have been performing as well. George, could you kick things off talking about what the market did in 2025 and how this has influenced the way this year has started?
Yeah. So it's always good to look back on the year that's been and sort of decipher what went well, what didn't go well. The chart that you can see here is market performance for the calendar year 2025. Less focused on sort of the different markets, but more focused on all the blue bar charts pointing to the right, essentially meaning positive performance. And, the Aussie to euro dollar doing negative, depreciating. So the big call out here is, we obviously had a lot of volatility in 2025 that people may forget about. We had DeepSeek come out in January last year. For those who don't know, DeepSeek was basically the ChatGPT replica in China. And what we saw was essentially an NVIDIA sell-off 17% in one day once that news broke out. And that was really centered on, if China can do it at a much lesser cost, then why are companies buying the NVIDIA chips for their AI expansion? What we ultimately saw was markets correct themselves, and it was a bit overblown in terms of what came to fruition. Then we saw in March, April, the Liberation Day tariffs come through, and we saw the volatility indices spike to 80, which has happened only 3 times in the last 30 years. We saw markets sell off anywhere from 10 to 15%, only to recover, the week after 10% in one day. And then we obviously saw, the Fed independence come into question with President Trump, the Jerome Powell arguments that became publicly available. President Trump tried to obviously fire one of the governors in the central bank, and that Fed independence really came to question. I guess the point is, despite all that volatility, markets were still positive. There are a few blogs that came out about, investors selling all the cash during the Liberation Day sell-offs. Essentially, they missed out on that real big increase in markets once they did bounce back up very quickly. And it's always harder to go into markets once you've sold out because you're waiting for, maybe a dip back down to where you sold out of. And then, when markets continue to grow, it's really hard psychologically to actually go back into the market. So I guess the point is, being invested throughout the market cycle is, what we do and what investors should be trying to do. And then if we look to 2026, it's actually been quite volatile, and some of the points we'll talk about further. Obviously, the geopolitical risk with Iran and US. But what you can see here on the screen is the year-to-date performance, a bit of a mixed mash compared to the previous chart we saw. Gold continues to shine bright, and we'll talk a little bit more about gold later on. Really, what we've seen year to date is that rotation out of those mega cap tech stocks or the US market into more diversified areas. So we've seen emerging markets do exceptionally well, and that's been off the back of Taiwan as well as South Korea. Those countries really have the big AI chip makers that are really dominating the earnings growth in those countries, and because they make such a big part of those indices, those companies can really drive the performance of those countries. We've also seen, obviously, Europe. We've seen Japan do exceptionally well, and maybe surprising, global infrastructure. That's been a real highlight for the markets year to date. Maybe I'll leave it there because obviously we'll go into a bit more detail about some of the individual factors, but I guess diversification is one of the things we preach, and actually knowing what you're investing in and sort of what asset classes you have exposure will obviously help protect on the downside when there is a big rotation in markets, which can obviously happen.
Yeah, very much agree with that. And if we take this a step further, Aaron, can you talk us through where we sit in the market cycle as well as some key risks that you're looking at?
Yeah, sure. So I think if you look at the economic cycle, it's fair to say we're probably mid to late. It's a little bit of art and science, but if we look at the key indicators, growth is fairly strong, unemployment is very low, it's hard to see it going much lower. The global interest rate cycle, we've been through a large cutting cycle and we're getting towards the end of that. While we do expect a few more rate cuts in the US, there's only maybe another 2 or so. And Australia's a little bit unusually starting to hike again. So that's indication that growth is quite strong and we're a little bit late in the economic cycle. But in terms of the market cycle, the other thing I'd say is to get commodities running quite hard. That's usually a little bit more of a later cycle indicator. In terms of the market cycle, I think it's very positive what we've seen this year. As George was saying, for the last few years, it felt like diversification wasn't working, because we just had the mega cap stocks going up and up and up and up and up. And we saw quite a lot of hype around artificial intelligence. And what you've actually seen in the last 3 to 6 months is the market getting more granular on winners and losers and trying to decipher a lot more. So that's actually really healthy to see. And we're seeing that more divergence in performance, which is really quite encouraging. In terms of those risks we're monitoring, there's always a lot of risks, but that is, that's just another day for us. That's what we're used to. And we talk about tail risks, so geopolitical, like we've seen. But some of these big artificial intelligence companies that could potentially list in the US this year is one risk we're monitoring, because that would be new supply coming into the US market. And if we think about the 3 that could potentially list, the likes of SpaceX, Anthropic, OpenAI, they could be trillion-dollar companies. So that is a risk to monitor, but that's just part and parcel of what we do. Yeah.
Okay, thanks, Aaron. I think markets are always moving, so we always have winners and losers. Yeah. For your portfolio, when we look at volatility can actually create an attractive opportunity. However, this is best approached with discipline. Our investment strategy is designed to navigate these cycles, and we incorporate managers that make adjustments when the evidence says it's needed. Aaron's just touched base on a number of risks, and we have a second poll will pop up. This is to do with what you think will have the largest impact on markets right now. So whilst we have the second poll up, maybe we'll get underway into our final theme for today, because it's probably the one that we've been talking about a lot, and it dominates headlines. And it's the major structural themes that are driving markets forward. So the powerful forces that shape risk, opportunity, and the path ahead. In the last few days especially, we've seen the conflict in Iran escalate after strikes from the US and Israel. The situation is quite complex, and when we see headlines like this, how do you think we should interpret their potential impact on markets? Is it short-term noise, or is it a genuine market-moving event?
And that's always the question, right? What's actually going to happen when all the geopolitical events occur? It's quite interesting to obviously see what you can see on your screen, and that is basically the performance after different conflicts have started. You'll notice that there are actually quite a number of times Iran and Iraq have actually there's been a war within Iraq or in Iran. But what this highlights is a lot of it can all be short-term noise, essentially. So what we see here is the conflicts that we've stated on the left. How many times over 1 month have we seen a positive market after that geopolitical event has started? And that occurs 77% of the time. And that's not to say that will always be the case. These are just obviously historical data points that we look at. But essentially what we see is, the market does tend to look through these events after a time when things become a little bit more calmer, when things become a little bit more clearer. And at the end of the day, what investors are looking at are what companies are presenting in terms of earnings growth. So if we talk about obviously the latest geopolitical event, Iran and the US, the biggest impact to markets at the moment is obviously the oil supply. So Iran's about 4 to 5% of global oil supply to the world. Now, that's not, I guess, the biggest percentage. The problem is obviously the Strait of Hormuz, where 20% of global oil is transported across. And that's been the biggest impact to markets. We obviously saw oil prices rise considerably in the last couple of days. The latest we've seen from President Trump is that, the US will be helping those tankers go through the Strait of Hormuz. So that will sort of hopefully put a cap on where oil prices go. But yeah, the biggest driving factor of the current geopolitical impact is, what's oil going to do? Because oil, is used in so many parts of the economies around the world, and whether or not that's going to be inflationary and add to sort of the woes of what central banks do in terms of, whether they keep continuing to cut rates in the US, or, they start to see some of the inflation impacts come through and, have to hike rates essentially. So the point is, a lot of it can be short-term noise as long as it is contained. At the moment, it is contained for now. We've obviously seen the impact of the US coming to sort of help put pressure on the oil price to drop lower. But, it's something that we'll monitor over the next few weeks to see, if that does expand into different countries and different areas.
You said noise, and I think the US has a lot to do with the noise around us.
Yes.
It's a big year ahead for US politics. How do you think elections and policy uncertainty typically flow through to markets?
Yeah, so we can look at two things. We can look at, presidential elections, when a new president comes into power, and we can look at obviously the midterms when that power can sometimes shift based on, how the public has perceived they've done. What the chart shows here is, midterm specific. What markets don't like is uncertainty. When markets don't know what's going to happen, they start to fall back. They don't really do much. Once we get that clear message of, who's going to be in power, what political system is going to be in the House, it's going to be in the Senate. We get a clearer understanding of, where we sort of see the economy to go, what policies are going to come through. What we see normally is the best result for markets is a hung government, Democrats, Republicans, and that really reduces the extreme policies that can actually be pushed through. It sounds counterintuitive, right? You want the government to actually take action, but it actually reduces the extremism that can come from policy rhetoric. So what you can see here is after the midterm election, it's 84% of the time, it's actually quite positive for the S&P 500. Again, past performance is not an indicator of future performance, but, the data is there pointing in the right direction that, once we get through that midterm election and we see sort of the president's third year, we may start to see a little bit more positive news coming through. The good thing about this election is obviously we saw the Republicans sweep in the recent election. The Democrats are actually expected to take the House. So, it falls to that sort of past history cycle of, markets really prefer a hard government coming into power.
I think that what you say about markets preferring a hung government makes sense to me when we think of America, because it's a bipartisan political system. So by nature of that, you would have very extreme policies on either side.
Yeah.
I think that's actually a great segue for us to look at the second poll results. So Brent, could you please quickly talk us through that?
Thanks, Alka. So there was one question that stood out. 52% of respondents said geopolitical risk is the biggest consideration. I struggle with this question because Trump and geopolitical seem to be the same thing at the moment. And Trump was second at 19. So if Trump is, I suppose, feeding into that geopolitical, then 71% of the answer is geopolitical. And third was 16% at AI.
Perfect. Yeah, that is interesting. Thanks, Brent. We're stepping a little bit away from geopolitics and talking about commodities. So something that's been in the headlines a lot is gold. Can you talk us through how the gold boom in recent years has started, whether it was a specific event or circumstance that this stemmed from?
Yeah, so it's quite a funny picture in front of us. If for those who don't know, that is the ABC bullion and the line to buy or sell gold, more particularly to buy gold at that point. And it's funny, Aaron and I walk past the ABC bullion every morning and every afternoon, and so we can use that as sort of a gauge as, you know, whether retail participation is increasing or decreasing. And for everyone's knowledge, there's been no one the last couple of weeks, so that's obviously something we can monitor. But yeah, this gold surge really took off. We have to go back a little bit to 2022 and the events of the Ukraine and Russian war. One of the things we saw after the Russian-Ukraine war, so typically gold is viewed as a safe haven asset. So when wars or geopolitical events, you know, come to fruition, investors will flock to gold and we'll see that price appreciation. That's how it's typically behaved. In 2022, we saw the same effect, saw gold increase as the geopolitical event occurred. But normally once that geopolitical event, you know, after a couple of months, it starts to subside. But what we saw was the price continue to appreciate. So what actually happened during the Ukraine and Russian war? Well, Russian assets got seized in the US. And one of the last things you want to do is obviously have your assets seized. And so a lot of the emerging market countries thought that their reserves could be used as a political weapon, especially obviously President Trump and, you know, the politics occurring in the US. So a lot of these emerging markets actually started to buy gold. So what you can see here is the real spike in net purchases in tons of gold for central banks. So, you know, Turkey, China, India, Poland, you know, some of the dominant players really increasing their internal reserves because they can ship the gold, they can hold it in their vaults on their home soil outside of the reach of, you know, different governments. So that was 2022, and we've seen that continue, right? It's dropped off a little bit, you know, as the gold price has appreciated as it has. But what else have we seen since then? We've seen retail participation increase quite a lot. Just showed you obviously the picture of the lines outside the ABC bullion, and that's really added to the volatility of the gold asset. So we've got that structural demand coming from central banks, but then we've also got that retail demand coming through. We've also had, you know, some of the likes of high net worth clients using gold as more as a strategic holding as opposed to, you know, dipping in and out during geopolitical events or market uncertainty. It's really become structural for some of these client portfolios as a hedge against, you know, everything going on in the world at the moment. One of the other pieces that we've seen is this gold debasement trade. So as different governments keep spending more money, you know, the actual worth of those currencies starts to drop because they start to print more and more money to cover these debts, and it becomes an unsustainable path for some of these governments. So some investors have started to, you know, we're not going to hold US treasuries, or we're not going to hold government treasuries, we're going to hold gold instead, because you can't print gold. Obviously, gold is still available and still being mined, but there is a limited supply of gold, whereas currency, these governments can continue to print and print more and more. So there's sort of been, you know, the perfect storm for gold to really do exceptionally well. And those structural factors are still occurring as we talk. You know, you can see the central bank purchases dropping a little bit, but,
yeah,
you know, we're still well above averages of the past, you know, decade.
Yeah.
So it's been, if you've held gold, you've done very well.
Yeah.
There are structural growth story at the moment.
Yeah. That makes a lot of sense, and it's quite interesting actually if you remove yourself from it. Something else that's dominated headlines is AI, and you've touched on it briefly today. We've seen in recent months that software businesses have been impacted by volatility due to the AI disruption concerns. I think the Fin had coined it the SaaS apocalypse or something like that. Aaron, can you talk us through this and touch base on whether you think it's a real earnings impact or it's just mostly thematic?
Yeah, so SaaS stands for software as a service, where you might pay $10 a month and you get your software. On the screen there, we've got the performance of the S&P 500 software sector versus MSCI World, which is effectively global equities. And I guess we've been conditioned in recent years to software and technology just continually outperforming, and that's certainly not been the case recently. So what's been driving it? You know, we've had AI and ChatGPT with us for a number of years now, and this isn't new, but it is a very fast changing sector. And one of the big changes in the recent months has been probably been driven by Anthropic or Claude, which is quite heavily embedded into enterprises and large companies. And this really accelerated through January and late January and February, which you can see on the chart there. This was a concern last year, but really accelerated this year, where you started seeing a lot of investors essentially selling first and asking questions later, because it became a real concern that some of this technological innovation was getting so advanced that potentially these AI firms could disintermediate, or basically you could replace some of these existing software providers. So examples in the Australian market that you might think about might be realestate.com.au or car sales. So instead of going to the realestate.com.au website, you could just use your AI assistant to say, hey, find me properties for sale in my suburb in this price range, etc. And it'll do that for you. It'll go around the internet, find all those property listings and deliver them to you. You won't need to go to these websites anymore. Now, I do think it has been a case of throwing the baby out with the bathwater. As we speak today, the ASX is up about 30 basis points, or 0.3%, and our technology sector is up 3%. So we're seeing this rebound now as the market starts to say, well, hang on, not all these companies are in trouble. There's still some very good companies here. And we haven't really seen a major earnings impact yet. In fact, what we've seen has been quite interesting. We've seen some quite large job cuts happening. So we've seen WiseTech and Block, which is a company that took over Afterpay, announcing some very large job cuts. And that's because these companies are getting very, very efficient, very, very quickly. So they're embracing these AI tools. And that's going to have a quite large earnings positive impact if we look out 1 year or two. So that's the kind of catalyst that the market's looking at to get more comfortable. And we've seen a bit of a nascent recovery in the last week or so in Australian and US software names. So that's good to see.
Yeah, perfect. We've touched on AI, commodities, and geopolitics. So the big question, which theme do you think will have the most lasting impact on portfolios?
They're all going to be with us, and we'll need to navigate them all. Geopolitics never goes away, and I think that table we showed earlier of all those prior conflicts, they will forever be happening, and we need to expect that to some extent. Commodities is very important for the Australian market, and we can't ignore that, but it is quite cyclical in nature. If we think back to a year ago, we saw lithium mines being closed because they were unprofitable, and now they're booming, but that will come and go through time. I do think artificial intelligence is the most structural thing we can talk about, that which will continue over the next number of decades, because it will be hitting all different sectors of the equity market, but also have impacts for the jobs market and have impacts for inflation. We think it's probably deflation long term. So I think that's probably the most important one to pay attention to. And you can see on the page here, this chart is an example of why we can't ignore it.
Perfect. I think there are plenty of forces driving markets. And the headlines can feel relentless, but the key is to cut through the noise. So my takeaway from what you've both shared is that if we focus on the core themes and where the real opportunities lie, we can make a far more balanced, constructive view when looking at portfolios and investments. It's been really great for me to sit here today with George and Aaron. There's been a lot of valuable insight. Brent, I'll hand back to you for the Q&A. I think we've got some time for that now.
Thanks, Alka. Thanks, Aaron and George also. There are a lot of questions that have come through on the Q&A. Let me just double check if there's been an update. One question, though, that came through is there's a lot of discussion around gold, but one, I think the question is, does it really add anything to the economy, and therefore is it just a barometer of trust?
Yeah, I mean, does it add anything to the economy is an interesting one. Certainly the WA economy, extremely important. because that's a mining economy. And we saw, I remember 12 months ago when those lithium mines were closing, the gold mines were booming. So even though there were job losses in the lithium mines, those workers were able to go to the gold mines. And so absolutely, and there's tax revenues and royalties. And there's other markets like the Indian economy and the importance of jewelry. But essentially, the market for gold now is very much an investor-driven market because the structure of it has changed over time. So the physical demand doesn't matter as much as it used to. We now have exchange-traded funds, and there's easier ways to get access to gold, which changes the dynamics of it. So I don't think the physical demand matters as much as it used to. Certainly, it does matter from an economic standpoint, but I think the bigger impact is it's really an investment-driven market, whether it's central banks or individual or institutions buying and selling gold. I think that's the larger impact.
Thanks, George. There's a question, maybe it's more of a comment, that that recent tactics by America, maybe specifically Donald Trump, with Venezuela and Iran are about a future play to potentially starve China of resources, or at least make it very difficult. And that, yeah, what is the implication? Is that potentially the implication, and what's the long term?
Yeah, so one thing you might not note is there's actually quite an important meeting at the end of the month between Xi Jinping and President Trump. We do think that maybe, President Trump coming out today and saying we're going to help sort of guide some of these tankers through the Strait of Hormuz does have some sort of play from this China-US relationship, and him trying to sort of say, we do need to have this meeting, we do need to have a discussion, because obviously these are one of the two largest economies in the world. So that's a very much a big play at the moment. Tariffs have started to come down. Obviously, there was a bit of a frosty relationship between China and the US last year. That's started to sort to ease as these tariffs have come down. Both parties are starting to come to the table. So we think potentially it is President Trump trying to make sure that this meeting does go ahead, and they do have the discussion about how things are going to move going forward. Aaron talked about obviously the AI disruption technology, and China and US are essentially trying to become the biggest players of these AI companies. So it may have something to do with that. There are a lot of things that play at the moment between that US and China relationship, and this sort of war is just one of them, given China's reliance on oil coming out of that region.
Yeah, I think I'll just add, it's an excellent question. I'll just pass on because I think the geopolitics and the commodities are very interlinked. So we can look at China's dominance of the rare earths market and really using that as a strategic lever, which the US responded to very quickly when they used it, because that goes into their defense, which is obviously very, very strategically important. You can look at just in January, talk of the US invading or taking on Greenland because of its vast resources. You can even expand it to the Arctic and the battle there with Russia and whatnot, and a bit of a land grab. So absolutely, these commodities and resources, whether it's energy, whether it's rare earths, etc., become crucially important because they are finite resources.
I did read that China and Iran had a good relationship when it came to trading, and that Iran would sell the oil to China and use the currency they received to then purchase goods. So it strengthened the Chinese dollar. Do you think that plays a part in the geopolitics or the US view?
Yeah, absolutely. That's definitely a touchy subject. So China's been, I guess they're essentially the contracts that they can do directly with other countries, particularly the likes of Russia and Iran. Where they can price it in their own currency. There's been a big push to that away from the US dollar. Now, obviously, the US doesn't like that. They would much prefer to be the global reserve currency for forever and a day. But there's these other rising forces, and as we know, India, China, they're getting larger and larger, and they're doing a lot of flow, and it's not always with the US, it's with other countries. So absolutely, and it can be a way to circumvent tariffs that may be imposed by the US as well. So yeah, we don't expect that to go away.
And that was super important for, this India-US trade deal that came through before, the tariffs were struck down, right? It was India buying oil from the Russians. And that was, obviously a big thing for Donald Trump to get through before, they reduced the tariffs from 50% to 25 to 18%. So, yeah.
It was playing politics, really.
Yeah.
So there are no other questions. That being the case, I'll wrap it up for the afternoon. Thank you, everybody, for attending. I hope you found this session valuable. Thanks to Alka, Aaron, and George also. There will be a poll that we would like you to respond to after the presentation. If you could, that would be great. We'd love to give your feedback about the content of these type of presentations, whether you think they're valuable and whether you want more of them. There will be a link to the recording distributed to attendees, so be on the lookout for that. And we've just got a slide on the screen now for post-webinar contact. So if you feel you would like to speak to or about personal financial planning, please reach out to Alka. If you're one of our corporate clients and just want to have a general advice discussion, myself and my colleague Michelle Shembry, our details are there on the screen. Please reach out. If you, I'll leave the screen open for a minute or two, just in case you want to take down those details. But unless there are any other questions or comments, thank you, everybody. Appreciate you attending this afternoon session. Thank you. Bye.
Thank you.